Welcome to this explainer. Have you ever wondered why a booming, highly innovative company, one with massive, guaranteed contracts, sometimes struggles to secure a simple bank loan, while a stagnant legacy business gets its funding approved without a second glance? It sounds completely backwards, right? I mean, we naturally assume financial systems are built to identify and fuel growth. But what if the very tools banks use to assess risk are actually structurally blind to tomorrow's most promising innovators? Well, today we're unpacking a really fascinating research paper produced in collaboration between the Aerospace Productivity Nexus, or AeroPN, and Bank Negara Malaysia. And honestly, it completely reframes how we think about risk, capital, and the future of advanced manufacturing. Okay, let's dive into this. Consider the core paradox that this entire explainer revolves around. Just imagine a precision machining SME. They supply highly complex structures to a global Tier 1 aerospace company. Now imagine another SME that supplies basic metal fittings to a domestic furniture maker. They might have totally comparable revenue, comparable balance sheets, and pretty much identical financial ratios. To a standard banking scorecard, these two companies look exactly the same, but they sit inside fundamentally different risk and opportunity structures. The aerospace supplier is part of a massive, global, high-value ecosystem, yet our current risk assessment system has literally no systematic way of reading that ecosystem. The authors of the AeroPN paper make a brilliant pivot here, captured perfectly in this one specific idea. We really need to stop blaming this abstract idea of conservatism among bankers. The problem isn't just a mindset, it's a structural mechanic. A genuinely creditworthy ecosystem story, like, say, having a massive export order book with a prime aerospace manufacturer, gets completely lost somewhere in the machinery of loan approval. To fix this, we have to find out exactly where that crucial information stops being seen. Section 1. The Risk Assessment Stack. Looking under the hood of bank approvals. Most people think a bank's loan decision is just one single monolithic process. You hand in your papers, a credit officer looks at your application, and says yes or no, right? Actually, modern banking is a stacked, vertical authority structure. Step 1 is indeed the transaction-level scorecard managed by the credit officer, but that is literally just the beginning. Step 2 is capital treatment, governed by international Basel rules, which dictates exactly how much capital the bank must hold against your specific loan. Step 3 is institutional governance, meaning the board's sector limits and overall risk appetite. And finally, Step 4 involves parallel domains. We're talking anti-money laundering checks, liquidity constraints, and expected credit loss staging. A loan application can get a glowing recommendation from a credit officer at Step 1, but still completely fail at any of the higher layers. Now, what's really interesting about this is where an ecosystem story might actually live on a classic credit scorecard. You'd think it would be in buckets like conditions or character. And sure, a credit officer might perfectly understand that a company is an approved Tier 1 supplier with a 5-year backlog. But here's the kicker. What actually lowers the bank's regulatory capital burden under the standardized approach? 5 out of the 7 buckets do absolutely nothing to the capital math. Only hard, eligible collateral moves the needle. So even if the officer reads the ecosystem perfectly, they have virtually no mechanism to translate that insight into a lower capital charge for the bank. Because those incredibly positive ecosystem traits don't help the capital math, banks are kind of backed into a corner. They have to rely heavily on what's called a recognized guarantee. This is a financial mechanism that basically substitutes a lower-risk guarantor's weight for the borrower's own risk profile. Without hard collateral or one of these recognized guarantees, the capital charge for lending to a growing, maybe slightly fragile SME is simply too high for the bank to justify, no matter how strong that company's industry relationships are. Section 2. Tale of 4 companies. Who actually gets funded? The AeroPN research constructed hypothetical case studies based on patterns from real aerospace manufacturing engagements to test exactly how this plays out. Let's look at 2 specific examples. Take a company we'll call Bramer. They're a family-owned legacy machining workshop. They have incredibly safe financial ratios, but absolutely no technology transition plan whatsoever, and their core market is facing severe disruption. They are entirely stagnant. Now contrast that with Solaris. They are rapidly growing, transitioning to a Tier 1 aerospace supplier with a massive $45 million contracted order backlog. But because they are heavily investing in capacity right now to fulfill that huge contract, their current financial ratios look very weak. And here is the devastating result. Under the standard risk framework, Braemar passes comfortably. They have the historical safety that banks love. Solaris, on the other hand, fails. Their most valuable asset, that $45 million export backlog, is simply not recognized as eligible collateral.
By only reading generic metrics without seeing the wider ecosystem context, the financing system ends up rewarding long-term stagnation and penalizing contracted high-value growth. It's essentially backing the wrong future.
Section 3. The hidden financial costs. The true price of risk aversion. Let's say a company like Solaris actually does manage to get approved for a supposedly concessionary, government-backed loan. What happens then? The research models a real-world scenario of an aerospace-adjacent manufacturing exporter that was granted a supportive facility. Imagine a 9-layer security stack placed on a single $23 million facility. The very first layer is a 90% government guarantee. You'd think that would be plenty, right? No way. The bank's risk process still piled on 8 further layers of defensive locks. We're talking personal guarantees, blanket debentures, assignment of sales proceeds, and forced cash collateral. It is literally like putting 9 deadbolts on a vault that's already empty. The institutional risk aversion was so intense that they defensively stacked security to an absolutely punishing degree. So the crucial point is this number right here, 19.2%. When you add up the guarantee fees, the trapped cash collateral, the reduced financing margins, and the independent accountants, this defensive structuring extracted 19.2%, or RM 4.42 million, of the facility's value right back from the borrower. A facility that was specifically designed by national policy to be supportive and concessionary was effectively neutered by the bank's operational layers. It drained the exact working capital the company needed to grow in the first place. And the friction doesn't stop at just one bank's risk department. The paper highlights another major failure mode, multi-agency coordination. Let's map out a case study named Ashford. This was a company participating in a genuinely innovative blended financing structure involving 2 different banks and a government equity partner. But if we track the dates, it's a nightmare. Because each institution had independent conditions that weren't properly sequenced, Bank 1's availability period lapsed just 1 day before the equity activated. This tiny mismatch triggered a cascading administrative bottleneck that dragged on for 8 agonizing months. The real-world consequences of this sequencing failure were devastating for the business. Because the institutions couldn't coordinate their conditions, RM 3.55 million in cash was locked up in term deposits and fees. And worse, because their liquidity was completely trapped, Ashford lost out on 2 confirmed Tier 1 aerospace contracts worth RM 30 million each. Their target revenue was delayed by up to 2 years. This proves that the problem extends way beyond just bank conservatism. The actual plumbing of the financing architecture is fundamentally disconnected. Section 4. Fixing the financing system. A structural answer. It is abundantly clear that we can't just point fingers and tell banks to be less conservative. The ecosystem information simply isn't translating into bankable capital math, and the institutional plumbing is fragmented. We have to structurally fix the system. And this brilliantly illustrates the path forward by looking outward to mature markets. Contrast the current fragmented Malaysian structure, where small suppliers bear all the risk and are judged entirely on their weak standalone financials, with the US Exim Bank and Boeing model. In that setup, through reverse factoring, a small, potentially unrated Tier 3 supplier simply borrows using Boeing's stellar credit rating. The supplier's own balance sheet isn't what's primarily being financed against. The prime contractor's credit standing is. It's a real game changer. Drawing on that exact comparator, the research paper outlines 3 concrete structural fixes. First, replace the chaotic transaction-by-transaction approach with a single, standing, reusable, multi-year guarantee facility. Second, implement a pricing mechanism where SMEs can borrow off the credit standing of their prime OEM contractors. And third, mandate absolute operational integration across co-financing institutions. This ensures that small companies never again lose months of time and millions in contracts simply because government-linked agencies fail to coordinate their paperwork. We've seen exactly where the ecosystem story gets lost, how much it costs promising companies, and structurally, how we can fix it. The data is clear, and the blueprints for a better system absolutely exist. But it leaves us with one final urgent question to consider. Will our financial architecture evolve rapidly enough to support tomorrow's most critical innovators? Or will we remain trapped, continuing to only fund the stagnant businesses that a generic, outdated scorecard already understands? Thank you so much for exploring this explainer with me today. Keep asking the hard questions, and always keep looking under the hood.